we said this. When you are a public company, you are required to prepare a complete set of financial statements for publication purposes. Then we said, what should you include as a company? What should you include in your complete set of financial statements for publication purposes? We said there are 5 components that should be included whenever you are preparing published accounts for publication purposes. Number 1 component we said that should be included is what we were calling the statement of financial position. That is the same as balance sheet. Number 2 we said is the statement of profit or loss and other comprehensive incomes. Number 3 we said it's the statement of changes in equity. Number 4 we said you should include a statement of cash flows. Number 5 we said you should include the accounting policies and explanatory notes. In other words, tell your readers of your financial statements what accounting policies have you as a company adopted in the preparation of your financial statement. Then we started by looking at how to prepare an income statement, or what you can call a profit or loss for publication purposes. How do you prepare a statement of profit or loss for publication, not for internal reporting, like the one you used to do in your financial accounting? There is a slight difference. And so we went through and looked at how to prepare a statement of profit or loss, or what you can call an income statement for publication purposes. We said you start with the sales. Go and find out from the question, how much are the sales for the company? Pick it, whatever it is. Then we said you now minus the cost of sales. And I told you, listen, I told you, for cost of sales, you don't show the workings of the cost of sales on the face of the income statement. We know that to get cost of sales, you normally take opening stock, add purchases, less closing stock. That's true. But we said that working should not be done on the face of the income statement. You remember I told you in your financial accounting, you used to show the workings on the face of the income statement. But for now, we don't show the workings. We said you do that calculation somewhere. Do that working for cost of sales somewhere. Then bring it as a figure in the income statement as a single amount. So you do the working somewhere, then bring the figure as a single amount. Good. Then once you do that, we said you get the cost of the gross profit. Once you get the gross profit, we said you normally deduct the expenses, but I told you we don't deduct the expenses by their name. In other words, you don't come and say let's say electricity, water, telephone, and so on. No, we said all expenses should be classified according to the function they perform in an organization. And we said there are 2 functions that may be performed in an organization. One is the administration function. Number 2 is the selling and distribution function. So we said if you as a company, you have incurred an expense and you think that expense is of administration in nature, then combine all your expenses that are of administration in nature, combine them somewhere, that's what we said, then bring them as a single amount in the income statement. Don't show the amount individually. No. So we said combine all the expenses that are of administration in nature, bring them as a single amount. Do the same for the selling and distribution expenses. All the expenses you as a company which you have incurred, which are of selling and distribution in nature. We gave examples like advertising, salesman salary, depreciation of delivery van, and so on. Combining all of them somewhere, bring them as a single amount in the income statement. Good. Once you do that, we said you get the net, and that net is what we were calling the profit from operations. Then from there we said you minus finance cost, you minus finance cost. We gave 2 examples. We gave 2 examples of finance cost. One of them is in form of interest, and the other one we said is preference dividend. It's preference dividend, but not just any kind of preference dividend. I do hope you remember. Of course, we shall discuss that later. We discussed it in details. But I will still remind you after a short while. But just remember, that we said 2 examples of finance costs include 1, interest on debentures or interest on loan, and preference dividend. And I hope you remember we said specifically on the redeemable preference share. Of course, I'll remind you in a short while. Good. After you have quoted your finance cost, we said you come and disclose your investment income. How much did you as a company receive? How much did you earn this year as your investment income? How much did you earn as your investment income? That's what we said you come and disclose. This investment income, we said, could be in form of dividend received or in form of interest received. You could have earned some interest, not paying interest, earning interest. Maybe you had bought a treasury bond or a treasury bill as a company and you are earning interest. That is an interest income. Good. Then from there we said you get the net and get what we were calling the profit before tax. Then from there we said come and minus the tax, but we said some questions have different forms of taxes. So you need to get the net of all forms of taxes. Get the net of all the forms of taxes. One, of course, we said is what we call the corporation tax. This is normally the same thing we normally call the current tax. In section 1 or financial accounting, you used to call it corporation tax. Then we said the other form of tax that the question may have is what we were calling deferred tax. I told you we shall discuss that in details, but you remember we said when it comes to deferred tax, there are times you'll be required to add the amount of the deferred tax to the corporation tax, or there are times you may be required to deduct the amount of the deferred tax from the amount of the corporation tax. Whichever the case might be, either you're adding or deducting, do that. Then get the net, push it to the extreme, and that is what we were calling the net expense in form of paying taxes, tax expense. Then you minus. Once you minus, then we said you call that figure profit after tax. Listen, just to remind you, we said when it comes to income statement for publication purposes, we said you don't do the appropriations. We said you don't do the appropriations of this profit in the income statement like you used to do in financial accounting. In financial accounting, you remember I told you, once you got the profit after tax, you had to minus what you were calling dividends, transfers to reserves, then you are getting what you were calling retained profit for the year. Then you remember you were adding retained profit brought down, then you are getting what you were calling retained profit carried down. We said for publication purposes, you don't do that in the income statement. You don't do those appropriations in the income statement. Instead, we said you have to do them in the statement of changes in equity, which we shall discuss later how to prepare it. So the appropriations we said are not done. The appropriations we said are not done on the face of the income statement. No, we said they are done elsewhere in the statement of changes in equity. Then I told you this, listen, if you are given this kind of a question and you are told number 1, prepare income statement, then listen, prepare income statement, then I told you, you stop after getting the profit after tax. But then I said, some questions may tell you, prepare a profit or loss and prepare a profit or loss or a statement of profit or loss and other comprehensive incomes and other comprehensive incomes. Or you could be told prepare an income statement and other comprehensive income. And so we said, if the examiner wants you to prepare an income statement and other comprehensive income, then you have to show other comprehensive incomes that your business have earned this year, whatever they are. And I'm not going back into the details. We discussed it in our lesson 1. We gave 2 examples for this illustration. We gave 2 examples. One of the examples we gave as a component that can be classified under other comprehensive income is what we were giving as a gain on revaluation of fixed assets. Gain on revaluation of fixed assets, that is an example of other comprehensive income. Of course, we discussed it in details. I can even see down here where we were discussing in details. And of course, I told you, listen, in simple terms, what are other comprehensive incomes? We said these are gains that your business could have made, but the rules of accounting for that gain does not require you, to take that gain to the profit or loss. I said, if you look at down here, assuming you had an asset called land, which had a book value of 100 million, if you revalued it upwards during the year by an extra 20 million, you must have debited asset called land, you must have credited revaluation. That's what you must have done. Then I told you, come the end of the year, you carry down the balance of that revaluation reserve and took it straight to the balance sheet. You took the revaluation reserve to the balance sheet directly as a component of equity. But this 20, we said it's a gain to the company. But the rule of accounting does not tell you to take that 20 to the profit and loss. As much as it's true it's a gain, you don't take it to the profit or loss. No, but it's a gain. So that's an example of what we were giving as an example of other comprehensive incomes. Good. So that's one example of it. Whenever you revalue a fixed asset, whether it's machinery, motor vehicle, furniture, building, whenever you revalue that fixed asset, you are required to consider the gain on revaluation, or it could be a loss on revaluation. Don't take it to the profit and loss. Take it as part of other comprehensive income. The other example I gave was what we were giving as an exchange difference on translation of foreign currency transactions. I don't have to explain that again. We discussed it in details. To explain to you. I can even see it here where I was trying to use dollar, blah, 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 just to illustrate to you how to deal with or how to determine the exchange difference. Good. Then from there, I can see as we proceeded, listen, after we proceeded, I told you that it's like now we are through with how to prepare an income statement for publication purposes. But then I took you back now to the income statement and looked at some of the challenges that the examiner might bring in your exams concerning some of those items in the income statement. How do you determine them? For example, we discussed how to determine the interest charge for the year. And I gave you some illustrations here. How do you determine what goes to the P&L account as the finance cost in form of interest? And I took you through some illustration here where I gave you this kind of an illustration. I told you in your financial accounting, which you did in your foundation level, you did a topic called company accounts. And I told you in that topic of company accounts, you used to be given a trial balance. And in this trial balance, we were assuming, suppose in that trial balance, you're given a 10% debenture, which amounts to 500,000. Then in the same trial balance, you are given the figure for interest, maybe amounting to 40,000. Then I told you, when you are required to prepare an income statement, I asked you, how much will you charge in your profit and loss as the interest for the year? And we agreed this, that, listen, that when you are preparing an income statement, we normally follow a concept we called accrual concept. We said you follow a concept we were calling the accrual concept. And what does that concept state? We said the concept says you as a business, you should recognize costs when they are incurred, but not when money is paid. In other words, when you are preparing the financial statement, recognize the charge for the year. Whether you have paid for that expense or you have not paid for it, you recognize costs when they are incurred, but not when money is paid. Good. So I told you that when this company will be preparing their P&L, they will come and ask themselves, how much is the charge for the year for interest? We said They have an interest which are debenture, which carries an interest of 10%. 10% is what they should be paying every year as interest. So we saw 10% of 500,000, that came to 50,000. That came to 50,000. And I told you that 50,000 is what you should charge in the income statement every year, whether you have paid it or not. Whether you have paid it or not. And that's what we said should go to the income statement. Why? Because the rule of accounting says you follow the accrual concept. When you are preparing financial statements, that means you recognize the cost when it was incurred, but not in the year it was paid. Good. Then I told you, when you are doing the balance sheet for that company, that's when you become concerned and ask yourself, as a company, do we owe our debenture holders anything? That's when you now go back to your trial balance and ask yourself, how much have we paid our debenture holders? According to this trial balance, we have only paid them 40. I was supposed to pay them 50. 10% of 500 is 50. So the charge for the year being 50, but I've only paid them 40. We said you owe them, you now as a company owe them the balance of 10,000. That 10,000 is what we were saying will go to the balance sheet as a liability among your current liabilities. Good. Then from there, I gave you another illustration again, where I gave you in some other questions of company accounts. Normally you are given a trial balance again, and in that trial balance you are given a 10% debenture amounting to, assuming again, 500. I asked you, from this trial balance, I can't see interest in the trial balance, but would you still charge interest in your P&L account? We said yes. It does not matter whether you have paid it or not. So long as debentures are there, interest must be there. Why? Because the accrual concept says recognize cost when it is incurred, but not when money is paid. So according to this trial balance, I'm supposed to pay my debenture holders an interest of 10%. 10% of 500,000 is what we saw as 50,000. That's what you charge in the income statement. Then I told you, when you are doing the balance sheet of that company, that's when you get concerned. You go back to your trial balance and ask yourself, do we owe our debenture holders anything? And according to this trial balance, we have paid them nothing. We have paid them nothing for interest. So automatically we saw the whole 50,000 becomes the charge for the year, and the whole 50,000 became the liability for the year, And so I concluded and told you, listen, whenever you are given questions of published accounts, the examiner will either test you on case number 1. When it comes to interest, it will give you a question or a trial balance where we have a case 1 where we said part of the interest is paid. Part of the interest is paid. Alternatively, in some other past paper questions, you are given a case 2 scenario where no interest is paid. No interest at all is paid. So you will need to know that it does not matter whether you have paid interest or not. When it comes to income statement, interest should be charged because of the accrual concept. It's when you are doing the balance sheet that you get concerned. Good. That's what we discussed. Good. Then from there, we discussed this thing called preference shares. And maybe before I remind you, because it was another critical area, maybe before I remind you about these preference shares, let's put down the summary notes now on what we have discussed so far, so that when I come and now summarize again the preference shares, then we put down the summary notes again there. But let us now put down the summary notes for the other areas we have reminded ourselves. So put down the topic published accounts. Put down the topic called published accounts. Put down the topic called published accounts. Put down the topic called published accounts. Then you say this. We are summarizing the notes now. You say this. Say this. A public company is required. A public company is required. A public company is required to prepare. A public company is required to prepare a complete set of financial statements A public company is required to prepare a complete set of financial statements for publication purposes. A company is required to prepare a complete set of financial statements for publication purposes. For publication purposes. Then you say this, another paragraph. A complete set of financial statements comprises of the following components. A complete set of financial statements comprises of the following components. A complete set of financial statements comprises of the following components. 1. Statement of financial position. Statement of financial position. Number 2, statement of profit or loss and other comprehensive incomes. Statement of profit or loss and other comprehensive income. Number 3, statement of changes in equity. Statement of changes in equity. Number 4, statement of cash flows. Statement of cash flows. Number 5, accounting policies and explanatory notes. 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 Okay. Then have another subheading. Statement of profit or loss. As a subheading, statement of profit or loss and other comprehensive income. And other comprehensive income. And other comprehensive income. Statement of profit or loss and other comprehensive income. So maybe we can just put down the format. There is nothing to put down in terms of notes for it. You just put down the format. So start with the sales. We have already reminded ourselves. Whatever the question will give you. Then from there you come to cost of sales. Whatever it is. Get whatever you are getting. That's what we are calling the gross profit. Then from there I said you minus the admin expenses. Whatever it is. I also said you minus the selling and distribution. Let me just call it distribution expenses. Whatever it is. Then I said once you minus the distribution expenses, you get the net. And that's what you call profit from operations. Profit from operations. Whatever it is. Then I said from there, you come to what we were calling finance cost. In bracket, you can put in bracket interest expense plus preference dividends. Then you show whatever it is, you minus. Of course, we shall talk about preference dividends in details in a short while. From there, we said you come to investment income. I gave an example like dividend received and interest received. Interest received. Whatever it is, you add. Then from there, you come to get the net. And that's what we are calling profit before tax. Okay. Once you get the profit before tax, we said you now come to tax. We said there are two components that could be there: current tax, or what some books will call it corporation tax. We said you adjust it with the amount of the deferred tax. I told you you either add or subtract depending on the question. We shall talk about that later. How to determine whether to add or subtract the deferred tax is something we have not talked about. We shall talk about it later. Once you adjust the deferred tax to the current tax, get the net. I'm pushing it to the extreme. You minus, and you call it profit after tax. Then I told you if the question just says you prepare income statement, that's where you stop. But if the question tells you to prepare an income statement and other comprehensive income, now you come and show other comprehensive income. Other comprehensive income. We gave an example of gain on revaluation. Gain on revaluation of fixed assets. Gain on revaluation of fixed assets. Whatever it is, gain on revaluation of fixed assets. That was one example of other comprehensive income. The other one was what we were calling exchange difference on translation. Exchange difference on translation of foreign currency transactions. Foreign currency transactions, whatever it is. Those are the two examples we gave, and any other, of course. Then from there we were saying get the total of the profit after tax and the other comprehensive income, and you call it total comprehensive income. Total comprehensive income. That is it. So that's just for the purpose of your format and for the purpose of your notes. Otherwise, we discussed it last time, and I've also reminded you today. So finish copying. We now proceed to the next item. Finish copying. If you are through, you can write the word done so that I know you are through. If you are through, you chat done so that I know you are through. If somebody says done, somebody says done, so let's continue. Oh, good, thank you. The other key item I want us to put down, listen, the other key item I want us to put down is the treatment of interest on that debenture. So have another subheading. Have another subheading, treatment of debenture interest. Very important, because I told you, whenever you are given a question on published, it will always be there. Interest will always be there. Treatment of debenture interest. We are going to put down the summary note in terms of illustration. So I want to call it case 1. Call it case 1, and you call it where part of the interest, where part of the interest, where part of the interest is paid. That is the case we want to deal with as our case number 1, where part of the interest is paid. Then you can show an illustration. Just assume like you're preparing a trial balance. So come and show like you're preparing a trial balance. In that trial balance, you say 10% debenture. Let me assume another 500 bado so that we can still remember. 500. Then in that trial balance, andika interest on debentures. Interest on debenture. Put on the debit column 40,000. Then you show like you're closing the trial balance. So that was our case number 1. That was our case number 1. Then below there, show like again you are preparing a P&L, profit and loss, and in that P&L, how much do you charge as far as interest is concerned? We said interest is the charge for the year, 10% of the amount of the debenture, whether you are paid it or not, and that comes to 50,000. 50,000. I hope you will not forget. We are getting it by taking 10% of 500. It's not what you have paid that goes to the P&L. No, it is the charge for the year, because we are following a concept called accrual concept. Then below that, come and show like you are preparing a balance sheet. Come like you are preparing a balance sheet. In that balance sheet, among the current liabilities, there will be interest owing. According to the trial balance, we have only paid them 40, but we were supposed to pay them 50. So there is an interest owing of 10. Interest owing 10,000. That is all for case 1. So finish. We want to go to case 2. Finish. We want to go to case 2 now. If you're through, you can now write again case 2, where no interest is paid. Where no interest is paid. That's our case number 2. So case 1 was where interest is paid. Case 2, where no interest is paid. Again, show like you are preparing a trial balance. And in that trial balance, you indicate 10% debentures. Again, an amount of 500,000. Show like you are closing the trial balance. Then you will be required to prepare an income statement. Then we said you come and see your P&L account. Interest. I told you whether you have paid it or not, you should charge interest in the P&L account, because you are following on a concept we are calling accrual concept. 10% of 500,000 is 50,000. Whether you have paid it or not, that's not the concern of the P&L. No. It is only becoming the concern when you do the balance sheet. Good. So let's show like you are preparing the balance sheet again. Among your current liabilities, you will ask yourself, do I owe my debenture holders anything? And according to this trial balance, I've paid them nothing. According to this trial balance, I've paid them nothing, but I'm supposed to have paid them 50. So I owe them exactly the same 50 because I've not paid them anything. So that same 50 will go to the balance sheet as a liability. So interest owing of 50. Good. That's all for that illustration. So we were just putting it down, or we are just putting it down to remind you when you are revising. Otherwise, it's a concept you should know by now. So finish. We now want to talk about preference shares. I want to remind you what we discussed in the last lesson about preference shares. We may not go back again into the details, but I just want to talk about how to treat it. Finish. If you are through, again, you write down. Good. Somebody has already written. Somebody has already written. Done. Okay, fine. Let's remind you again before we start something new today. Let me remind you what we said concerning preference shares. Let me remind you what we said about preference shares and preference dividends. Let me just again use a new page here. You don't have to go back to where we wrote, but I hope you still remember the key points. I hope you still remember the key points when we were discussing preference shares. We said this. Listen, that when a company wants to raise finances, that company can decide to issue preference shares. Then I told you, one company decided to issue, let's call it company A, they decided to issue a 10% redeemable preference share. They decided to issue a 10% redeemable preference shares amounting to 20 million. That's one company. 10 years ago, they wanted to raise finances. They issued a 10% redeemable preference shares. Another company B, the same 10 years ago, then they decided to issue a 10% non-redeemable preference shares. Non-redeemable preference shares, again amounting to 20 million. So we saw both companies are raising 20 million from preference shares. But first we have to ask ourselves, what's the difference between the redeemable preference share and the non-redeemable preference share? And we said this, listen. Redeemable preference share is a share that the company will be required to buy back. That's why we are calling it redeemable, because the company will redeem it, will redeem the shares. So when you as a company, company A, you issued this 10% redeemable preference share, at that time you are telling your shareholders, a time will come when I will be requiring to pay you back your 20 million. But for company B, when they were issuing the non-redeemable preference share, they were not required to pay back the 20 million for company B. So in other words, we concluded, you as company A, the moment you issued your redeemable preference share, that automatically means that you as a company A, you have an obligation to pay back the 20 million. But for company B, we said they have no obligation to pay back the 20 million. Good. And so, I asked you this question. When these two companies will be preparing their balance sheet at the end of the year, will they take the two figures of the company A and company B? Will they take the preference shares to the same part of the balance sheet? And we agreed the answer is no. I told you, for redeemable preference share, you as company A, you don't take it to the balance sheet as part of capital. I told you that? No. Why? Because you have an obligation to pay back that 20 million. And because you have an obligation to pay back the 20 million, we said you as a company A, you will consider your 20 million preference share as a liability to you. As a liability to you. But for company B, which has no obligation to pay back the 20 million, we said for company B, they will take their 20 million as part of capital. So in other words, we said they will take their 20 million as part of equity in the balance sheet, where they normally have ordinary share capital, share premium, general reserve in the balance sheet, and so on. That's where company B will put their 20 million. So that is one key difference. As I said, one should be very careful whenever you are given a question of published accounts. And we said in that trial balance, if you find that there is preference shares, you will need to ask yourself, are these preference shares redeemable or non-redeemable? Because the examiner wants to see where will you take the figure to the balance sheet. If in one sitting he gave you a redeemable preference share, he expects you to take it to the balance sheet as a long-term liability. As a long-term liability. Let me show you what we discussed in the previous class. Here. I can see it here. Here. Listen. So we were saying something like this. Just the same way you treat debentures as a liability, a non-current liability. Why are you taking debentures as a liability? Because you have an obligation to pay back the debenture holders. So it's the same we said for preference shares. If you issued a redeemable preference share, then you take it to the balance sheet as a liability, long-term liability. You can see it there. That's what we discussed. Otherwise, for non-redeemable preference shares, we said you take it to the balance sheet as a component of equity among the equity components like share capital, ordinary, share premium, general reserve, and so on. That's where you now bring in the non-redeemable preference share. That is important. The other key point we talked about, let me come back here. The other key point we mentioned was these two companies will have to pay preference dividend at the end of the year. Every year, they are required to pay preference dividend at the rate of 10%. So 10% of the 20 million, company A will be required to pay a dividend of 2 million, while company B, also having issued a 10% non-redeemable preference share worth 20 million, they will also be required to pay a dividend of 2 million. Listen, then I told you, this 2 million dividend for company A and company B, will they treat the dividend in the same way? Will they treat the dividend in the same way? Their answer again, we agreed, is not. For company B, which issued a non-redeemable preference share, whatever dividends they pay to their preference shareholders, whatever dividend they are paying to their preference shareholders, that we said should be considered as an appropriation of profit. Where? In the statement of changes in equity. In other words, where you do your appropriations of profit by taking profit after tax, you minus the dividend, you minus the transfer to reserves, get the retained profit for the year, blah, blah. That's where you minus the dividend on the non-redeemable preference share. So we concluded by saying any preference dividend on non-redeemable preference share should be considered as an appropriation of profit in the statement of changes in equity. Otherwise, we say any dividend on redeemable preference share, that should not be considered as an appropriation of profit. No. Why? Because we say, remember you borrowed some funds, and the cost of borrowing, like the cost of borrowing through debenture, is the interest you pay the debenture holders. So the interest you pay to the debenture holders, that's an example of a finance cost. You borrow to finance your business, so the cost of borrowing by issuing debentures is interest on debenture. You also borrowed by issuing redeemable preference share. What's the cost of borrowing? The cost of borrowing is the dividend you will pay to the non-redeemable preference shares. And we concluded, listen, that the dividend on the redeemable preference share should be considered as a finance cost. That's what I have just said a short while ago here when we were putting down the format. I have said the dividend on redeemable preference share should be considered as a finance cost. So the one we were combining with the interest is the dividend on preference shares, which are on redeemable preference shares. I hope you are getting, not on the non-redeemable. only for the redeemable preference share. That's the one you consider as an example of what? A finance cost. Good. That's what we said. So I think I've reminded you what we said about the preference shares and the preference dividend. How do we treat preference shares? If it is redeemable, take it to the balance sheet as a liability. If it's non-redeemable, take it to the balance sheet as a component of equity. That means as capital. Then I've also said for dividend, if you pay dividend on redeemable preference share, the dividend should be considered as a finance cost in the income statement, while the dividend on the non-redeemable preference share should be considered as as an appropriation of profit in the statement of changes in equity. Good. So let's put down that summary note. It's an important note to remember. So have it as a subheading. Treatment of preference shares. Treatment of preference shares and preference dividends. As a subheading, treatment of preference shares and preference dividends. Treatment of preference shares and preference dividend. Treatment of preference shares and preference dividend. Just a minute. Okay. Treatment of preference shares and preference dividend. Then you say this. If the preference shares, put down this, if the preference shares are redeemable, they should be considered as a financial liability. It should be considered as a financial liability. They should be considered as a financial liability in the balance sheet. They should be considered as a financial liability in the balance sheet. Please stop. Continue. This is because the company that issued them, has an obligation to pay back that amount in the future. Has an obligation to pay back that amount in the future. Has an obligation to pay back that amount in the future. Has an obligation to pay back that amount in the future. Another paragraph. If the preference shares are non-redeemable, they should be considered as a component of equity. They should be considered as a component of equity in the balance sheet. They should be considered as a component of equity in the balance sheet. They should be considered as a component of equity in the balance sheet. They should be considered as a component of equity in the balance sheet. Another paragraph. Preference dividend on the redeemable preference shares. Preference dividend on redeemable preference shares. Preference dividend on redeemable preference shares should be considered as a finance cost, should be considered as a finance cost in the income statement, or you can just say in the profit and loss. We are saying preference dividend on redeemable preference shares should be considered as a finance cost in the profit and loss. In the profit and loss. Another paragraph. Preference dividend on non-redeemable preference share. Preference dividend on non-redeemable preference shares should be considered as an appropriation of profit. Preference dividend on non-redeemable preference shares should be considered as an appropriation of profit, in the statement of changes in equity. In the statement of changes in equity. In the statement of changes in equity. Good. Fine. So I think I've reminded you what we said last time, and we have written down the summary notes. So let me go back and discuss a few more items before we go to the next components. Don't forget, we are still discussing how to prepare an income statement for publication, but because we had some issues like dividends, finance costs, and so on, I want to discuss one more item that can brought. I have said preference dividend on non-redeemable. Preference dividend on non-redeemable preference shares should be considered as an appropriation. Should be considered as an appropriation of profit in the statement of changes in equity. In the statement of changes in equity. Should be considered as an appropriation of profit in the statement of changes in equity. Are you okay, Florence? We move on because you have said I repeat. Florence, are you okay now? Yes, fine. So let me develop the topic now. So we are now continuing fresh. Now, the other thing I want to talk about now, which I told you last time I'll talk about, is this here. When you look at this income statement, which we have just talked about, I said there are times you deduct deferred tax, and there are times you add deferred tax amount to the current tax. Current tax does not change. The examiner will give it to you. He will tell you the corporation tax charge for the year is 5 million, 20 million, blah. That's okay. But when it comes to deferred tax, you either will be given a requirement or you will be given a question where you will be required to add the charge for deferred tax to the current tax, or you deduct the charge of the deferred tax to the current tax. Good. Okay, let me discuss it now. Listen. First, I want to say deferred tax is a topic on its own. We shall do it in details as a topic on its own. It's a topic on its own which is normally tested in financial reporting. It's normally tested on its own. But for now, I just want to give a summary view of how to use it to compute deferred tax. How to calculate the amount called deferred tax that you charge 5 million. How did they get the 5 million? That's not my concern. That is a concern we shall deal with in the other topic of deferred tax on its own. But now I want to assume they have given you the amount, or you have got the charge for the year. Okay. But now you need to ask yourself, do I add the current tax or do I deduct? But first we start by just briefly asking ourselves, what is deferred tax? It is obvious from the term deferred tax. I think you can get something. From the term deferred tax, you can get something. Listen. As a company, let us assume you made a profit before tax this year of 800,000. If you take this profit to the taxman, he will not tax you on 800,000. Why? Because this 800,000, which is your accounting profit, you determined it using your rules of accounting principles and concept. Normal rules of accounting principles and concept, which is okay. Whenever a company is preparing the financial statement called income statement, they follow their normal accounting principles and concepts. So you determined and you made a profit of 800. Now, listen. You thought, because the tax rate is assuming, let's assume 30%, you thought you'll be required to pay 30% of 800 is about 240. But, listen to this now, when you take that 800 to the taxman to tax you, he will not tax you on 800,000. He will calculate his own profit that you should pay tax on according to the tax rules. He might calculate and tell you, you're going to pay tax on 750,000. Let us assume so. He will calculate his profit according to the tax rules and now realize you're supposed to pay tax on 750,000. So, in that case again, now listen, that is what we shall be calling the taxable profit. So, according to the taxman, he normally calculates what we call the taxable profit. You as a business, you compute the accounting profit, which in your case, you got it as 800,000. You thought you'll be required to pay 240. But for tax purposes, he applied his tax rules and looked at your financials. From those financials, he said, maybe you should not have charged this, you should have charged this, you should have charged this. Of course, we shall discuss that in details in the topic of deferred tax. But he will look at your income statement and say, this should not have been part of your income according to their rules, not according to your rule. Your rule is supposed to be there, but according to them, maybe it should not be charged this year, it should be charged next year, and so on. So he computes tax, a profit, and he says, you are going to pay tax on 750. At 30%, he will require you pay how much? Let me just do that for purpose of illustration. Just for purpose of illustration, what is 30% of 750? That's about 225. Listen. So while you thought you're going to pay tax on 240, the taxman told you, no, you're not paying tax of 240, you are paying me tax of 225. So there's a difference between mine and his by how much? By about 15,000. Listen. Does it mean that as a business, I'm not going to pay the taxman that extra 15? The answer is no. I've told you, listen. While I computed my profit and I got it as 800, I gave the taxman that profit. He looked at my profit and loss and removed some items from there, and he said, this one should be charged next year, or this one should not be charged according to their tax rules, and so on, blah, blah, blah. Then he got as an amount of 750. So he required I pay him tax of 225. The question is this. does it mean that I'm not going to pay him that extra 15? The answer is no. Listen, the answer is no. A time will come when I'll still be required to pay that extra 15. For now, he just wants me to pay him 225. While I thought I should pay him 240, he will require I pay him 225 and I'll pay him. But that does not mean that I'm not going to pay that extra 15. A time will come when I'll be required to pay that extra 15. So what do I do now as a businessman? Because I know a time will come when I'll be required to pay that extra 15, it is prudent that you defer paying that 15 until a later date. You defer paying that 15 until a later date. Whereby, listen, whereby now you will create a liability now in your books as a company, create a liability now in your books to be paid in the future. So you will defer paying that 15. How do you defer paying that 15? By taking it to a liability account, or in other words, creating a liability now to be paid in the future. So you will create a liability by opening an account called deferred tax. You will defer paying that 15. So to create a liability obvious, you know you have to credit a liability account. A liability is always a credit balance. So in the first year, you will debit what we are calling profit and loss by that 15, and you will credit deferred tax by that 15. And then by the end of the year 1, you will carry down the balance, that 15. You will bring down the balance by the beginning of year 2. This is year 1. So by the beginning of year 2, you will come and say your balance brought down another 15. That is the same 15. Listen, suppose in the second year, this I'm assuming to be year 1. Suppose in year 2, whatever the profit you made, let us assume you made a profit of 750. I'm assuming you thought you will be required to pay 225. 30% of 750, you may only 225. But for tax purposes, again, in the second year, the taxman computed the taxable profit akapata something like 800,000. Akapata 800,000 here. So he will require you pay 30% of that. 30% of 800 is 240. Look at the argument in the second year now. My profit in the second year was 750. I thought as a businessman, I'll pay 30% of it, which is 225. But the taxman took my profit and said this and this should not be there, this and this should be there, blah, 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 blah. He computed his profit and got an amount of 800. So he will require pay tax on 800, which comes to how much? 240. A difference of how much? Again, 15. Listen to this now. So this second year, I am being required to pay more than I thought I should pay. As a businessman, I thought I should pay 225 in the second year. But the taxman is now telling me to pay him 240. So I'll ask myself this question. Where will I get that extra 15 from? So as a businessman, I'm going to recall it from where I deferred it. Because I must have deferred some amount. So when a time will come that I'll be required to pay more than what I thought I should pay, that is the time now you go and recall what you deferred. And that's what we call, you now have what we call a transfer from. You have what we call a transfer from the deferred tax. Remember, in the first year you deferred, or listen, in the first year you transferred 15,000 to the deferred tax, where you created a liability to be paid in the future. We normally say you are transferring 15 to the deferred tax. A time has come in the second year where you are now going to be required to pay more than you thought you should pay. So the question is, where will I get that extra 15? You now go and recall it from where you deferred, or in other words, you go and transfer it from the deferred tax. So in the second year, now you recall. Remember, it has a credit balance, it's a liability. Now you recall. So you come and debit deferred tax and you credit P&L account by that 15. So I have explained in simple terms, I've explained to you in simple terms how deferred tax comes about. But we shall do the computation in details, but I've just explained to you deferred tax arises because you thought you should pay this much, but the taxman says pay less. Does it mean you're not going to pay that extra? No. So what is the most logical thing to do? The most logical thing for you to do as a business is to defer paying that 15. Until when? Until a later date. How do you defer? By creating a liability now to be paid in the future. You create a liability now to be paid in the future. To create a liability, you take the 15 to the deferred tax. So you credit deferred tax by that 15, which automatically means the double entry is you credit deferred tax, you will debit P&L account here. In the first year, you must have debited P&L account. In year 1, you must have debited P&L account, and you say here deferred tax 15. Good. In the second year, now you are being required to pay more than you thought you should pay. So you ask yourself as a businessman, where do I get that extra 15? While I thought I should pay 225, the taxman says now I pay 240. I am now going to recall it from where I deferred. So in the second year, you transfer 15 from the deferred tax. How do you transfer it? I have told you deferred tax is a liability. A liability is always a credit balance. So to transfer from, you go now debit deferred tax, which automatically means you will credit P&L in the second year. Good. Now, with that idea, answer me the following questions now. Listen. We have already said deferred tax is a liability. So let me assume that you as a company, by the beginning of this year, you had a deferred tax liability. Let us assume by the beginning of this year, your liability was assuming something like 2 million. Or let's say 20 million. Let's call it 20 million. Now, listen. Then the question tells you, as an additional information, transfer 5 million. Transfer 5 million to the deferred tax. Transfer 5 million to the deferred tax. The question is, will you debit deferred tax by 5 million or credit? Somebody chat and you want to see if from the additional information, I'm assuming from the trial balance. Listen, from the trial balance, you have been given a balance of deferred tax 20. Then from the additional information in the question, the examiner tells you transfer 5 million to the deferred tax. Question is this: will you debit deferred tax by 5 million or will you credit? I want to see somebody chatting. Transfer 2 million to the deferred tax. Will you debit the deferred tax by 5 million or credit deferred tax by 5 million? Yes, I want to see another opinion. I'm not saying it's right or wrong. If you have listened to what I've said so far, you should be able to answer that question. So which one are you giving me? Willie, you have said debit then credit. I want you to choose one. It's either you are debiting this account or you are crediting this account. Thank you, Willie. Sasa you have settled yours. You have said you credit. Somebody else by the name of Ekorogos, amesema credit. Okay, so let me go by those two. Of course, I expect more answers, but you are right. Listen, I've told you, deferred tax is a liability account. A liability account, I've said, is always a credit balance. So when the examiner tells you transfer 5 million to the deferred tax, you will come and credit the deferred tax by how much? By 5 million. Now watch, which automatically means in your P&L, you will debit by 5 million. In your profit and loss, you come and say your deferred tax, 5 million. Listen, your profit before tax, down here, let me use an illustration. Your profit before tax here was assuming to be 200 million. The question gave you, and you came and said your tax, the question gave you the amount of the corporation tax, let us assume 30 million. That one will be given, corporation tax, or what you can call current tax, 30 million. Listen, then you are now being told, transfer 5 million to the deferred tax. Now listen, I have said you will credit deferred tax by 5 million, you will debit P&L account. Watch now, this 5 profit of 200 million, profit is always a credit balance. So on the P&L, the profit is here, 200 million. Our corporation tax is 30 million. Don't forget, listen, we pay taxes out of profit. We pay taxes out of profit. So it means if out of 200,000 I'm supposed to pay corporation tax of 30, that automatically tells you that the amount of the corporation tax here is normally debited in the P&L account. Corporation tax is normally debited. That one, there is no question about it. Because you are paying it out of the profit. Profit is always a credit balance. So if you are paying 30 million out of 200, profit being a credit balance, then it automatically means you're going to credit or to debit P&L account by 30. Now, listen. I have been told by the additional information transfer 5 million to the deferred tax. What did I do? I credited deferred tax. Watch now. I debited P&L here. I credited deferred tax. I debited P&L account. So my question is, when I debit P&L account by 5 million, and in that debit, on that debit side, there is this deferred tax of 30. Am I increasing the 30 with the 5 million or am I reducing the 30 with the 5 million? Somebody give me the answer. I have debited P&L account by 5 million in form of corporation tax. No, in form of deferred tax. In that P&L account, there is a debit of 30. So when I'm debiting P&L account by a 5 million, am I increasing the 30 or am I reducing the 30? I want somebody to chat. Am I increasing the 30 or reducing the 30? In other words, listen, when you debit an account which has a debit, are you increasing the debit or are you reducing the debit? You debit an account which has a debit. Are you increasing the debit or are you reducing the debit? Good. Willie says you are increasing. Somebody else by the name of somebody is also saying you are increasing. Good. So when you debit an account here by 5 million and that account has already another debit, you are increasing the debit. Listen. So in your income statement here for deferred tax, that 5 million, you will add it to the 30. So you'll get a tax expense of 35 and you minus. Okay? Listen. In another sitting, you also went to the same trial balance. You went to the trial balance of that question. You found a balance brought down of deferred tax 20 million. Then the examiner told you from the additional information, listen, transfer 5 million from the deferred tax. Transfer 5 million from the deferred tax. So already deferred tax being a credit balance, and the examiner is now telling you to transfer from the deferred tax 5 million, you will automatically come and debit deferred tax, and you say your P&L account 5 million. Which automatically means, listen to this, which automatically means in your P&L account here, you will credit now 5 million. And you come and say a deferred tax 5 million. Don't forget, normal profit is a credit balance. Your profit before tax was here for 200 million. Your corporation tax was 30. I've told you we normally pay taxes out of profit, so the corporation tax will always be a debit, which is a 30. But this time, the examiner told you transfer 5 million from the deferred tax. From the deferred tax. What did you do? You debited deferred tax, you credited P&L account by 5, sorry. So the question is this. When I credit this account by 5 million, am I increasing the 30 or am I reducing the 30? When I credit P&L account by 5, am I increasing the 30 which is on the debit or am I reducing the 30? I want to believe you are okay now. It is obvious you are reducing. When you credit an account which has a debit, then you are reducing the debit. You are reducing the debit. Meaning, listen, in your income statement, if you do it in vertical form, you will have profit before tax of 200 million. You will come and say your tax. One is corporation tax, you have 30 million. Then utakuja useme hapa deferred tax. For this time, I am crediting P&L account. I'm crediting P&L account by 5 million, while on the debit of the P&L account, there is a 30. So automatically, I'm reducing the 30. By how much? By 5. So when it comes to income statement, that deferred tax will be deducted. So you will remain with a tax expense of 25. Okay? So I've talked about one way in which the examiner can test you concerning deferred tax. He will tell you transfer 5 million to the deferred tax, or he might tell you transfer 5 million from the deferred tax. So it's the double entry that will guide you. Though we are preparing our income statement in a vertical format, but if you look at P&L account in a T format, it will guide you. I started by saying this. Your company had a deferred tax liability of 20 million at the beginning. That's normally given in the trial balance, whatever the amount the examiner will give you. Then somewhere he told you transfer 5 million to the deferred tax. So you said, okay, 5 million I'm transferring to. Deferred tax is always a liability. A liability is always a credit balance. So when I'm transferring to, then I must be crediting again. Good. So you went and credited 5 million in the account called deferred tax. But which account did you debit? You must have debited P&L account here by 5 million. Then you argued corporation tax is always paid out of profit. Profit is always a credit balance. The corporation tax is obviously a debit in the P&L account. But we're not discussing corporation tax, we are discussing deferred tax. So this 5 million I've debited in the P&L account. I will ask myself, is it increasing the 30 or reducing the 30? It is obvious. By me debiting an account with 5 million and that account has a debit of 30, I'm increasing the 30. So when they say transfer 5 million to the deferred tax, of course, I'm increasing the amount of the charge. I'm increasing the amount of the charge in the P&L account because the charge for corporation tax was 30. I am debiting P&L account by another 5, so I'm increasing the charge of 30. So I come and add ndio. Then I've also told you, listen, in another sitting, ukaenda kwa trial balance, ukapata deferred tax balance in the trial balance is 20 million. Ukaambiwa from the additional information, transfer 5 million from the deferred tax. Okay? If you're transferring from, and yet deferred tax is always a credit balance, and now you're being told to transfer from the deferred tax, then automatically it means you are going to debit deferred tax. Okay? Good. Which means the other account to be credited is P&L account here. You are crediting P&L account by 5 million, yet on the debit of that P&L account, there is a corporation tax of 30. So you are asking yourself, am I increasing the 30 or am I reducing the 30? It's automatic. You are reducing the 30. When you credit an account which has a debit balance, you are reducing the debit. So in that case, you will come and deduct the 5 million from the corporation tax. Good. Now, that is one language. I want you to listen to another language the examiner could use. Not the change of answers, but the language. Now, number 1. Look at that deferred tax. Sometimes the examiner could tell you, as an additional information, deferred tax to be increased by, listen, deferred tax to be increased by 5 million. So you went to the trial balance, you got a balance of 20. You brought it down. Now the examiner is saying deferred tax to be increased by 5 million. The question is, will you credit the 5 million in the deferred tax or will you debit? It is obvious. If the examiner says, I increase the deferred tax by, and I know deferred tax is always a credit, to increase it, then it means I must go and credit. Because it's already a balance of a credit. If I'm increasing it, I must go and credit again. So I go and credit by 5 million, and automatically it means I'm debiting P&L account by how much? 5 million. Of course, you are debiting P&L account by 5 when there is another debit of 30 in the name of corporation tax. So the question is, are you increasing the current tax or are you reducing the current tax? It's obvious you are increasing the current tax. So in that case, you come and add the 5 million, you come and add it to the corporation tax. So listen, so that is now a different language which says transfer. The first one was transfer 5 million to the deferred tax. This time another sitting examiner says increase the deferred tax by 5 million. Deferred tax to be increased by 5 million. That same language is the same as saying transfer 5 million to the deferred tax. Why? Because I've told you deferred tax is always a credit balance. It's always a credit balance. So if I'm transferring to, then I must go and credit. Or if I'm told to increase it by, then I'm going to credit because it's already a credit. So to increase a credit, you credit. Which means you go credit the deferred tax, you debit P&L account. We are debiting P&L account by 5 when there is already a debit of 30. So automatically you are increasing by another 5. Good. What if in another sitting, you went to the trial balance of that question and you got a balance of 20 million called deferred tax as a liability, obvious. Then you read the additional information and you are told deferred tax to be reduced by, deferred tax to be reduced by 5 million. So if it is already 20 and it's a liability, and now the examiner says to reduce it by 5 million, you cannot reduce a credit by crediting again. You reduce a credit by debiting. So you'll come and debit deferred tax by 5 million, which automatically means you're going to credit the P&L account. I've told you corporation tax is paid out of profit. Profit is always a credit balance, and therefore if corporation tax is paid out of profit, it must be on the debit. But now the language was reduce the deferred tax by 5 million. To reduce the deferred tax, I debited deferred tax, I credited P&L account. So I'll need to ask myself, when I'm crediting P&L account by 5 and there was a debit on the side of 30, am I increasing the 30 or am I reducing the 30? It is obvious you are reducing the 30. So in that case, you come and minus. Okay, good. So there are different languages that the examiner can use sometimes to confuse you when it comes to deferred tax. Sometimes he says transfer to, transfer from, increase by, reduce by, and so on. So what is more important is to understand the double entry. When he said transfer to, I credited deferred tax, meaning I debit P&L account. When I'm debiting P&L account by 5 million and there's already a corporation tax of 30, I am going to add. Same way I said when they are told to increase by 5 million. The same thing. If I'm increasing by 5 million, I will credit deferred tax, debit P&L account. Debiting P&L account by 5, when there's another debit, therefore I add. Good. Alternatively, I was told transfer 5 million from. I was told transfer 5 million from the deferred tax. When I was told transfer 5 million from the deferred tax, what do? I debit deferred tax. I'm transferring from. I told you deferred tax is always a debit balance. When I'm told to transfer from, I debit. Meaning I credit P&L account. I'm crediting P&L account by 5 when there's a debit of 30 on the debit of the P&L account, meaning I'm reducing the 30. So when I'm told to transfer from, I am reducing the corporation tax, which is 30, I reduce it by 5. When I was told deferred tax to be reduced by 5 million, same thing, I'm reducing by. I have already said deferred tax is always a credit balance. So to reduce it by 5 million, then it means I go debit deferred tax, I credit P&L account. Crediting P&L account by 5, when there is a corporation of 30 on the debit, means I'm reducing the debit by 5. I hope we are together so far. So I hope now you have understood when to add the 5 million to the corporation tax and when to deduct the 5 million from the corporation tax. Okay, good. Of course, we shall be doing questions, so it will become clearer as we shall do the question. But I now know you have understood simply when to add the deferred tax of 5 million, when to deduct the deferred tax of 5 million from the deferred tax, depending on the language the examiner will try to coin, either increasing deferred tax by, reducing deferred tax by, transfer this amount to the deferred tax, transfer this amount from the deferred tax, whatever the language. Okay, so it's just the language that you have to understand there. Good. So there is nothing to put down as a summary note. There is nothing to put down there as a summary note. What I just wanted you to do is to understand that there are times you add the deferred tax to the current tax, and there are times you deduct the current tax from the deferred tax. So I just wanted to show you when do we add, when do we deduct. So there is nothing there to put down the summary in terms of notes. Good. Now, listen. So that brings me to the end of the first document or the first component. I think I've discussed it in details now, how to prepare it for publication purposes, and that is what we are calling statement of profit or loss and other comprehensive income. I don't think there is something else I've left. Otherwise, the rest are just challenges that the examiner will bring as normal challenges in any income statement. Otherwise, for purpose of publication, now you know. Good. So let me discuss the next one on how to prepare it for publication purposes. for publication purposes. And the first one, or the next one I want to talk about, is how do we prepare balance sheet for publication purposes. How do we prepare balance sheet for publication purposes? So I want you to listen now. Don't write. I want you to listen first. Balance sheet. That's what we are calling statement of financial position. How different is it from the one you used to prepare in your financial accounting? Now, you'll all remember that when you did it in financial accounting, when you were preparing this balance sheet for financial accounting, you had to start with what we were calling fixed assets, or we can call it non-current assets or fixed assets, whatever you are calling it. Either land, whatever it is, you remember, motor vehicle, furniture, building, all those fixed assets that you had. Then from there you came to current assets. You had to start with stocks, whatever it is, debtors, whatever it was, you remember all that. Then you had to come to bank or cash, whatever it is. You had to get the total assets. Then you had to come to equity and liabilities, where you listed the capitals and the liabilities. Now listen. When it comes to balance sheet for publication purposes, only one small thing is changing. The rest remain the same. Now listen. When you are preparing a balance sheet for publication purposes, listen, you are not required to come and show these individual assets, which we are calling the fixed assets. You are not required to show the individual assets in the name of land, machinery, motor vehicle, furniture, building, and so on. No. In other words, don't come and tell the readers of your financial statement the value of the land was this, furniture was this, motor vehicle was this, and so on. No. Listen. You are required to combine all your fixed assets somewhere. Combine all your fixed assets somewhere and bring that amount, combine your fixed assets, all of them somewhere, bring it to the balance sheet as a single amount under the name, under the name of property, plant, and equipment. Under the name of property, plant, and equipment. So I've said that according to the balance sheet for publication purposes, do not show the individual fixed assets in the balance sheet, like machinery, motor vehicle, furniture, land, building. No. I've said combine them somewhere, bring it as a single amount in the balance sheet under the name of property, plant, and equipment. Under the name of property, plant, and equipment. Listen to the other point. Then, if you as a company, you have any other fixed asset, but that fixed asset cannot be classified as being part of the property, plant, and equipment, that is the only time you are now required to come and show them individually in the balance sheet. Any other fixed asset which does not qualify to be classified as part of the property, plant, and equipment, that is the one now you come and disclose individually. In most cases, listen, in most cases, these are intangible assets. Intangible assets like goodwill cannot be classified under property, plant, and equipment. You remember, when you are doing financial accounting, you prepared or you did a topic called depreciation. In that topic of depreciation, you used to prepare what you used to call a fixed assets movement schedule or a property, plant, and equipment movement schedule. In that property, plant, and equipment movement schedule, you remember, there were various columns. each column represented a particular asset like land, building, machinery, motor vehicle, land, maybe furniture, and so on. Then the last column, you remember, it was for totals. Now, listen. You obviously remember that you never used to take this property, plant, and equipment movement schedule. You never used to take an asset called goodwill there. No. You only had to take the tangible assets. Those are the ones you classified as property, plant, and equipment. Furniture, building, land, motor vehicle, and so on. Now, meaning any other asset which does not qualify to be part of property, plant, and equipment, then that is the time you now come and show them individually in the balance sheet. I've already given you an example of one of them, and that is an asset called goodwill. You cannot qualify or classify goodwill as part of property, plant, and equipment, no. The other one, for example, is investments. When you have an investment in form of shares or investment in terms of debentures of another company or bonds, that's an intangible asset. You are just given a document. Okay? So you classify it as part of other assets. Already somebody has given me another one. Good. Patent. Good. When your company has patent rights, obvious, that's another intangible asset. Trademarks, correct. So these are examples of assets that cannot be classified as part of property, plant, and equipment. And those are the ones you now show them individually in the balance sheet. Okay? So we are giving examples like goodwill, investment, patents, trademark, copyrights. All these are fixed assets, but they are intangible in nature. So you are required to show them individually. Listen, otherwise, the balance sheet, the other sections of the balance sheet, even for publication, remain the same. How you present the current assets remain the same. How you present the equities and the liabilities remain the same. The only difference I've said is how to present the fixed asset section. I've said you don't show the individual fixed assets in the balance sheet by the name of land, building, motor vehicle, furniture. No. Combine them somewhere, bring them as a single amount under the name of property, plant, and equipment. Then I've said any other fixed assets that does not qualify to be part of the property, plant, and equipment should be shown individually in the balance sheet. Then I've given you examples: goodwill, investments, trademarks, patents, copyrights, and so on. Good. So those are the few examples of intangible assets. I'm not saying they're the only ones, but they are few and the most commonly used in your exams. Good. Otherwise, the rest of the balance sheet remains the same. The rest of the balance sheet remains the same. So I think we can now put down one statement to represent that information. So have it as a subheading. Have it as a subheading, statement of financial position. Andika statement of financial position. We want to put down that statement. We are not putting down the format. We're just putting down that paragraph information. Then you say this. Say this. All fixed assets should be shown. All fixed assets should be shown and as a single amount. All fixed assets should be shown as a single amount in the balance sheet. All fixed assets should be shown as a single amount in the balance sheet under the name of property, plant, and equipment. 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 I've said all fixed assets should be shown as a single amount in the balance sheet under the name of property, plant, and equipment. Another paragraph. If the company has any other asset, which cannot be classified as part of property, plant, and equipment, then it should be shown separately. In the balance sheet. Please stop. This may include assets such as goodwill, investments, patents, trademarks, copyrights, etc. These may include assets such as goodwill, investments, patents, trademarks, copyrights, etc. Okay. So that's all we can say about that. So as far as balance sheet is concerned, you now know the key important point. Just bring in the figure called property, plant, and equipment. In short, we normally call it PPE. Property, plant, and equipment. We normally call it PPE. Okay. Now, I'm supposed to go to the next component, which is now what we are calling statement of changes in equity. I'm supposed to start now the component statement of changes in equity. That is statement of changes. This is statement of changes in equity. But I have no time to introduce it and finish it. This is some more detailed. This is a bit more detailed. So you will allow me to stop there for today. I pick it up from there next time, where now we shall continue. From there, now I discuss the remaining few. Once I discuss the remaining few, then we shall be able to do a past paper question. So allow me to stop there for now. But maybe before we stop there, some of you are watching me and this is your first time to join the class or to join this class. So if you are here, let me just mention this. If you are here and you have not joined our online classes, or you are here and your friends would want to join our online classes, tell your friends that we have online classes for the following subjects. 1, we have online classes for advanced financial reporting of the advanced level. Tell them we have online classes for financial reporting of the intermediate level. Tell them we have online classes for financial management of the intermediate level. That is financial management of the intermediate level. Tell them we have online classes for financial accounting of the foundation level, or the one of ATD1 and ATD2, because they also have financial accounting there. Tell your friends that if they are not able to join the live class, then they can still buy what we call the pre-recorded videos. They can buy the pre-recorded videos and watch them at their own free time. And whenever they have a question, they can call me anytime. I will assist. Okay. Now, so we are saying, tell your friends that we have online classes for those 4 subjects. 1, advanced financial reporting of the intermediate level. financial management of the intermediate level, financial accounting of foundation level, and the one of ATD1 and ATD2. I've said if they are not able to join the live class, they can buy the pre-recorded videos where they can watch the videos at their own free time. To reach me, you can call me on this number 0722 65 8875. 0722 65 8875. If you need the country code, then it will be 254 722 65 8875. Okay. Now, before we close the class, listen. Some of you are watching me through YouTube. Some of you are watching me through YouTube. And therefore, listen. If you are watching me through YouTube and you have not subscribed to my YouTube channel, please click that subscription button. Click that subscription button down there and subscribe. This will help you to be notified whenever we post new videos into the YouTube. So please subscribe to my YouTube channel by clicking that subscription button so that every time we post new videos into the YouTube, you will be notified. Okay? I hope you have liked the class. Those who are watching me through YouTube, please click the like button also to like the class. I hope you have managed to understand something for today. So click that like button to like the class. Okay? Now, my YouTube channel is called CPA Joseph Njuguna. That's the name of the YouTube channel, CPA Joseph Njuguna. So if you go there, you will find some of my YouTube channel and my YouTube there, which are there for promotion. Of course, not all, but there's a sample of the videos for promotion. Go to that channel. If you have not gone there, click and subscribe. If you have not subscribed to my YouTube channel, you can even watch some of the videos that we have posted there for free for promotion. Otherwise, see you next time. I hope that those who are watching now, at least you have managed to understand something for today, that you have gone home with something. Is it okay? Is it correct? Somebody, I hope you have understood something. Just a comment or two. For those who are watching me now, if you have understood something at least, say yes, so that we close the class for today. We start next time. Thank you very much. That is somebody. Yes. Michael says he has understood. Thank you. Thank you. Yes. Thank you. Sawa. That's okay. That's good to hear that. That at least you have gone home. Florence, thank you. You have said yes. Fine. So see you next time where I'll discuss the remaining components for purpose of publication. Then from there we do a past paper question. Thank you. Have a good night. See you next time. Is PPE examinable? Yes. It's part of property, plant and equipment. It is. It is. Fine. See you. Maybe I could also say this.